Picture this. One day, stocks are soaring, everyone feels optimistic about the future, and the next panic hits, layoffs begin, and suddenly everyone's Googling, what is a recession? Recessions sound scary, but in the US, they're as regular as coffee breaks on Wall Street. Over the past 50 years, America has been through oil shocks, interest rate pain, dot-com collapses, housing meltdowns, and global pandemics. This is your guided tour through 50 years of the USA's most notable recessions and what lessons they hold for investors. In the early 70s, America got an expensive wake-up call. In 1973, a group of oil-producing countries called OPEC stopped exporting oil to the U.S., and others who supported Israel in the Kippur War. This led oil prices to spike from about $3 to nearly $12 per barrel, shaking the global economy. Around the same time, President Nixon took the U.S. off the gold standard, ending the Bretton Woods system. This global agreement had kept currencies stable by tying them to the U.S. dollar and the dollar to gold. Once it ended, the government could print more money freely, which helped fuel inflation. As a result, GDP tanked, unemployment soared, and economists coined a fun new term: stagflation, stagnant growth with high inflation. Good times. The stock market didn't escape either. The S&P 500 fell by about 48% from its early 1973 peak to its late 1974 low. Investors had to wait until 1980 for the market to fully recover its previous highs. By the late 70s, inflation was running wild, fueled by soaring oil prices, easy money policies, and supply chain shocks, including disruptions from repeated energy crises, the 1979 Iranian Revolution, cutting oil supplies, and broader shortages of key commodities like metals and food staples. Prices were rising fast, eroding paychecks and confidence alike. Something drastic had to be done. Enter Paul Volcker. The towering 6'7" Fed chair decided the only way to kill inflation was to attack it head-on. He raised interest rates to a staggering 20%. Yes, you heard that right, it worked. But not before triggering a double-dip recession. The economy fell into recession, started to recover, and then plunged again, delivering two painful contractions back-to-back. The stock market also took a beating. The S&P 500 fell about 27% from late 1980 through mid-1982. It took until late 1982 for the market to begin a sustained recovery. In the late 90s, excitement over the internet's potential fueled a frenzy of speculative investing. Companies with little more than a website and a dream, like Pets.com, eToys, and Webvan, raised billions through IPOs. Valuations skyrocketed, often without profits or even viable business models to back them up. When reality set in, the bubble burst. The tech-heavy Nasdaq collapsed by 78%, wiping out trillions in market value. Add in the shock of 9/11, and although the resulting recession was relatively short, it left lasting scars on investor confidence and the broader economy. The Nasdaq didn't recover its 2000 peak until 2015, a 15-year slog. The 2008 financial crisis, or the Great Recession, was a big one. For years, banks handed out risky home loans called subprime mortgages to people who often couldn't afford them. Housing prices soared, and Wall Street created complex financial products tied to those mortgages, piling risk on top of risk. When housing prices stopped rising and borrowers started defaulting, the entire system cracked. Major banks like Lehman Brothers collapsed under the weight of bad loans. The economy plunged into the worst downturn since the Great Depression, with millions losing their jobs, homes, and savings. The S&P 500 fell about 57% from its peak in October 2007 to its bottom in March 2009. Recovery wasn't quick. It took massive government intervention, stimulus packages, bank bailouts, and aggressive monetary easing to stabilize the system. Even then, it wasn't until March 2013, nearly 5.5 years later, that the S&P 500 fully recovered its previous highs. In early 2020, a new virus spread rapidly across the globe, triggering a worldwide health crisis. Governments imposed lockdowns, businesses closed, and travel ground to a halt almost overnight. The sudden economic shock caused the fastest bear market in U.S. history, a 34% drop in just weeks. Mass layoffs followed, but so did historic stimulus. The government sent out relief checks, expanded unemployment benefits, and the Federal Reserve slashed interest rates to near zero while injecting liquidity into the markets. Thanks to aggressive action and early optimism about vaccines, financial markets bounced back rapidly in just 5 months, even as the broader economy recovered more slowly. In 2022, inflation returned with vengeance. The Fed hiked rates fast and markets wobbled. Some sectors fell hard, but was it a recession? Some argued it was, others pointed to strong job growth and consumer spending. Even official definitions sparked debate among economists. Adding to the uncertainty in 2025, new tariffs and rising trade tensions raised fears that protectionist policies could slow economic growth even further. Whatever it is, it reminds us, downturns never go out of fashion. So, what are the key investor takeaways? Recessions reset the economy. Painful, yes, but they clear bubbles, cut excess, and plant seeds for the next boom. Markets usually recover before the economy does. That's why staying invested tends to pay off long term. But smart investing during downturns isn't just about staying the course. It's also about evaluating your risk tolerance and making sure your portfolio matches it. Keeping a cash reserve for emergencies so you're not forced to sell investments during a crash. Being ready to spot opportunities when great companies go on sale. Staying diversified across sectors, not betting everything on a single stock or industry. Downturns can feel uncomfortable, but with preparation, they can also create your best long-term gains. Recessions hurt, but understanding them helps you invest smarter, manage risk better, and stay calm when markets get rocky. Build savings for emergencies, stay diversified, and be ready, because some of the best opportunities often appear when things feel the bleakest. If you found this breakdown helpful, hit like and subscribe. And remember, stay smart, stay steady, and stay minted.